You put in the hours, you tolerate the claustrophobic commute, take on the extra projects, and wait for the annual raise. Yet, despite burning immense amounts of energy, you constantly find yourself scraping the bottom of your checking account by the end of the month. Look at the standard educational curriculum we all went through. Schools require years of algebra, geometry, and historical memorization to graduate. But practical instruction on how to manage, protect, and grow capital is entirely absent from the syllabus. This creates a cycle where expenses rise to meet income, leaving the balance sheet stagnant. People secure better job titles and earn higher salaries over time, but their lifestyle costs expand at the exact same rate, keeping them permanently anchored in debt. The people who accumulate lasting capital aren't doing it by simply grinding out more hours at the office. They are operating from a completely different rulebook, a set of mechanical financial habits that most people never encounter. By the end of this breakdown, we will examine 5 specific skills used to break that cycle, ending with a specific mental shift, skill number 5, that dictates exactly how the wealthy interact with their resources. Because if you do not understand the hidden mechanics of how money actually operates, pouring more physical effort into your job only accelerates your financial exhaustion. Look at a standard payday. Direct deposits hit and immediately scatter to bills and loans. You're left with tiny drops at the bottom. Successful accumulators reverse this. Skill 1, pay yourself first. They automate investments before any external expenses. This strategy moves wealth creation away from relying on daily willpower. It turns saving into a silent, automated background process that compounds year after year. Financial security requires reclassifying your own future as a non-negotiable expense. You engineer a system where the first mandatory bill you pay is to yourself. Typical borrowing centers on financing lifestyle. Swiping credit cards for depreciating goods and stretching car loans creates a heavy drag on your monthly cash flow. This leads to skill number 2, distinguishing between types of leverage. Taking on high-interest consumer debt to impress peers quietly erodes your net worth. Taking out a low-interest loan to acquire a cash-flowing asset, however, utilizes leverage to accelerate your net worth. Now apply that structural thinking to how you earn. Imagine waking up tomorrow morning to an email stating your current job has been eliminated. Your sole source of income has completely vanished. A single thick pipeline creates one point of failure. If it breaks, the machine shuts down. Skill 3, build redundant income streams. Overlapping sources, like dividends or freelance skills, act as fail-safes, keeping your economy running if the main pipe ruptures. Relying heavily on consumer loans and a solitary paycheck creates a fragile life. Acquiring productive assets and maintaining redundant income streams engineers a system built to withstand economic shocks. This brings us to a pervasive trap. Assuming a high salary automatically equates to being wealthy. People routinely earn $500,000 a year and still operate on a month-to-month basis. Trading your time and expertise for cash is the skill of earning money. Allocating those funds effectively is the entirely separate skill of growing money. To bridge this gap, you need skill number 4, putting capital to work. Instead of viewing cash exclusively as a tool for immediate consumption, effective allocators treat their capital as an employee. They assign it to perform labor, deploying it into index funds, into real estate, or business equity. Early on, returns look negligible, but compounding requires time to do its heavy lifting, eventually gathering massive momentum independent of your daily effort. True financial accumulation has very little to do with the initial size of the cash flowing in, and everything to do with how effectively that cash is put to work when you step away from the desk. Which brings us to the final piece of the architecture, skill number 5, the capacity for financial thinking. We can map out cash flow diagrams and compound interest models all day, but mechanical solutions fail if the underlying psychology is compromised. A vast majority of financial distress stems directly from fear, emotional spending, and poor impulse control. To counter this, successful investors build a mental checkpoint before executing a transaction. They always ask critical questions. Does this purchase serve my long-term stability? Am I acquiring this out of necessity, or am I reacting to stress? Society expects wealth to be loud, signaling success through luxury cars and designer purchases. The reality of wealth building is incredibly quiet, a series of deliberate, emotionally detached decisions repeated consistently over decades. So, looking at the mechanical and psychological gaps in our education system, which of these 5 financial skills do you believe schools should prioritize? Let me know your thoughts below. And stick around because in our next breakdown, we are dissecting specific money mistakes that carry a much steeper price tag than you might realize. You can possess a deep understanding of interest rates and market caps, but mastering the mechanics of money proves useless without mastering your own mind. Financial freedom is ultimately won and lost through impulse control.